Bring that ass back like a boom, 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 boom.
Hey, what's up everyone? This is Supernova from Boom Traders, and you're with our weekly review for the last week of April. Today's May the 1st, and let's start with the session overview. Like usually, we're gonna continue with the risk vest model. The tactical trading environment comes second. Then we're gonna take a look at the current markets a little bit more extensively, and then we're gonna do a summary. So, all negative. The signal is negative. The general market, the up-down volume, new highs, new lows, stock participation, always negative. You will see in a little bit when we look at the charts. Pretty much all the major indices have undercut their prior lows and are looking bearish. Tactical trading environment, unless you are trading breakouts to the downside, it's red, meaning that breakouts to the upside are likely to fail, so maximum caution is advised, and if you ask me, cash is king. So with that out of the way, let's look at the current markets. I have some notes for you, then major indices, gold, crypto, oil, market internals, VIX, top and bottom in industry groups, sentiment, and summary. So let's take a look at my notes, and then we're gonna continue with the charts. So looking at my notes, I have a couple of things that I had 2 weeks ago as well. We have the yield curve inverting, inflation rising, major slowdown in earnings, and escalation of war to NATO countries. I will pay more attention to the yield curve inverting and the inflation rising in just a bit, but I want to talk about major slowdown in earnings. We saw Amazon and Google reporting subpar earnings, whereas Facebook actually beat earnings and it had a 2-day rally. But with the weaker market, it was expected, and Facebook fell again on Friday. So it's coming to fruition. Our fears about slowdown in terms of earnings are happening. So this might be the turning point for the indices, and we can see them much lower. But we're going to talk about some levels when we look at the charts in just a little bit. The other thing that was a problematic situation was our thinking of escalation of war to some NATO countries. And last week, Finland and Sweden, still not part of NATO, bid to join NATO, which comes as a further deterioration of relationship between NATO and Russia. And Moldova, which is also a neighboring country to Russia, expressed fears that it might be the next country to be invaded by the Russian forces. However, right now, all the movements are geared toward Donbass and Lugansk territories, where Russia is expected to basically take over those territories that were declared independent prior to Russia invading Ukraine. And Russia, of course, officially said that they are okay with Lugansk and Donetsk being independent territories. So, in terms of yield curve inversion, the 10-year minus the 2-year headed back north, and since mid-April has turned back down and might probably undercut that low and might really go inverted here. But remember, when we spoke about it, yield inversion is not something that definitely brings market crashes. More so, it's a signal that something's wrong with the market. So if you think about it in terms of options, this is basically me telling you that the time decay for your options that are expiring in 2 years will be higher than the time decay that is expiring in 10 years, which sounds strange for those of you that are familiar with options. Same thing with 10-year minus 3 months, and I don't really see how this one can invert anytime soon, so just take it as it is, as a picture if you want. If you see somewhere on the news or somebody talks about yield inversion, yes, the 10-year minus the 2-year might invert, but the 10-year minus the 3-month, well, that will be really strange. So, couple of words about inflation. This is the 1-year adjusted inflation. You can see consumer price indexes by Bureau of Labor Statistics. Energy soared more than 30% year over year, whereas food and all items, including food and energy right here, soared more than 8%. And you can see right here, 8.5% in March. This is year over year percent change. 8.5% in March, and this is the third highest on record since 1965. We had only two spikes that were higher, that was in 75 and 80. Last but not least, I also want you to pay attention to the M3 money supply for the United States. You can see that money printing has been going strongly. Here's the steep rise in 2020 over COVID fears, but it hasn't really decelerated much. So that's about my notes. Let's just take a look at some of the indices and market internals now. Starting with the S&P 500, you can see we are almost undercutting the lows right here. This is a daily chart on the S&P 500. We're almost undercutting this previous low right here at the end of February. Now, what is important to note here, every single time that we have a bounce in the market, we need volume to support this move. This is not the case when we're looking at topping formations. For example, if you see right here, we have a bounce supported by large volume right here. And then we move up, and right here at the top, actually volume is depleting and we're dropping down. Now when we go for support, as I said, we need volume. Right here, end of January, huge downward move, lots of volume to support it, we go up. Right here, we're going up, there's no volume, we're going down. Volume coming in, same story, volume depletes, we're going down, volume coming in. Volume going up, price going up, and volume is depleting. And right now, what you can see right here is typical for bottoming formation. We see more volume coming in. So if this one doesn't hold, I have a couple of levels for you guys here to watch. This is the 404 level, and then there are two lower levels right here, around 370, 372. I really hope we don't get there, but that's what the S&P 500 is showing right now. Looking at the NASDAQ already undercut the previous lows from January and February, and we're now looking for a move downwards. Let me just restore that and move to the weekly chart so we can see. And we have two more levels right here that we're looking for. Now this one was undercut, and you can see right here there was not a lot of volume to support this. Yes, there was, but not a lot, not as much as right here. So this is a major level. Also looking for continuation of this breakout. So this breakout resistance right here flipped to support, and right here we touched it. We were able to bounce pretty heavily, huge volume coming in. And you can see the volume that we have right now on this weekly bar is actually higher than the volume that we exhibited right here. So this might suggest some bottoming formation. Although when we look in the internals in just a second, you will see that nothing there is suggesting bottoming formation. This is IWM on the weekly, and the level that I'm seeing here for support is 165, 166. These are some extensions that I drew prior to recording the presentation. This is 78.6 extension from this move right here. So I'm looking for this to hold. We already undercut, and let me just remove the drawing so you can see. Clear drawing set, yep. So you can see we already undercut those lows right here that we've been holding for quite some time. So this is the one level, and then we have this one's second low right here. But we're already below that, so we're looking for the next logical level. And in terms of volume, the next logical level that I see is right here. That's why I said 165, 166. Last but not least, Dow Jones. And Dow Jones looks like the healthiest of all indexes right now. There's some volume coming in right here, but remember, we are below the key moving averages for the weekly chart. These are the 10 and the 40 period moving averages. We're below them, and I don't really see how this can push higher, but you know, these are the markets, so you never know. Now let's just move to the market internal, so I can show you what I'm looking at and why this seems like it's giving us conflicting signals where it wants to go. Highs, net new lows. So let's just start with the S&P 500. Really, there's really no need to explain that. You can see the reddish right here at the bottom. This is the net new lows are more than the net new highs. This is the advanced decline line straight down. Although on the S&P 500 we have not undercut this low, the advanced decline line is long gone and it's making new lows. So nothing really suggests that this is bottoming action. So it basically suggests further move to the downside. Looking at the QQQ, it's even more ominous. Basically, you can see all the way since our sell signal right here on 22nd of November last year, the advanced decline line has been going straight downwards. Net new lows have been more than net new highs. And last but not least, looking at the IWM, pretty much the same story. Advanced decline line has been moving south. New lows have been more than the new highs, and it's looking quite bearish. This is just the advanced decline line right here on the Dow Jones. I don't need to do net new highs, net new lows, because there's only like 30 tickers, so it doesn't really make any sense. But the advanced decline line has been in a steady basing formation right here, and now we are actually tagging the upper channel. So this looks fairly positive for the Dow Jones. So this might be the last glimmer of hope for the market. Let's just take a look at the put-call ratio. Put-call ratio has increased a little bit. It's 0.895 at the moment, and this is pretty much almost the highest point it has been for this year. We had a little bit higher levels right here the end of February, but remember the prices were not lower, especially if we're talking about the S&P 500 and Dow Jones. So it is suggesting that we might see a little bit increase in terms of puts, and then we might be bottoming out. But you know, as I said, markets are markets. Not trying to predict it right here. So back to commodities. So first thing I want to start with is oil. Of course, always oil has been a headliner recently. So this is how the weekly chart of oil looks, and it looks like we are in a basing, trying to form a basing formation right here. Now, if we look at the daily, which is more interesting in this sense, we're seeing some consolidation, moving up and down, up and down, but there's still quite a lot of volatility right here. And I don't think that with current conditions we can expect the volatility to decrease that much. But this looks like it's setting up to go higher. Another one that has been actually even more bullish looking to me is natural gas. So you see we had this cupping formation. We hit the high right here, 8065. And now we're forming sort of like a handle, so this might be playable if this breaks out to the upside. So you see right here, if we drew this trend line, this this breaks to the upside, this might be playable. So it's a 3-touch trend line right here. However, bear in mind natural gas is very seasonal based, so it's something that you want to keep in mind if you're trading in. Gold actually took a tumble down on Friday. Wasn't expecting really that. When markets are weak, gold is generally expected to rise, but we made this piercing to the upside, trying to get back into the formation of this handle. We couldn't, we rejected, and now probably lower prices are coming. So this is how it looks. Bitcoin is trying to test the 38,000 level. We have support at 35,000, but when we speak about sentiment, you will see that it's at extreme bearish conditions right now. Extreme fear is in crypto sphere. So this is usually a contrarian indicator showing that we might see a reversal soon. So now let's go to the industry groups, then look at sentiment and do a market summary. Top industry groups, not much of a change. Coal is number 1 right now. Last week it was number 4. We had a couple of stocks in coal that was moving upside. BTU actually reported subpar earnings, which was surprising given the fact that Arch, for example, reported superior earnings and it's moving higher. Chemicals and agriculture, these are MOS, this is CF, this is NTR, although most of them are reporting earnings this week. So it's we'll see how this one goes. We have, again, the usual suspects: oil and gas, royalty trust, drilling, international, US integrated, Canadian, and this one is a new one, retail, super, and mini markets. Has moved 2 places to the upside. Now, I've also listed some of the top movers in terms of industry groups. Communication services, document management, IRM. This was a nice trade. We also have finance and credit cards, American Express, Visa, Mastercards, diners. Oh, actually, this is Discovery. They are moving quite well. So these are all the industry groups that have recorded a move of more than 30 spots from last week to this week. And I think commercial services, that was like 79 or 80 spots. So that's huge improvement. Here are some of the top leading companies in these groups. If you want to just pause the video, take a look at those groups, you might find something interesting. PAG, I had an alert, didn't see it in time, and just broke out a beautiful pattern. Actually, one of the few that actually looked really good. But let me just show it to you really quick. I think so. You see, we had this cup formation right here. There's no real handle, but it's like a basing structurally, and then we had this 3-trend touch line right here, and I had the alert to play right here, but I saw it at the end, and Friday came, and yeah, couldn't trade it at all, but that's what it was looking for. So in terms of the worst industry groups, I don't think there's much of a surprise. Computer, banks, super regionals, electric, scientific, medical research. Not much of a change. And you can see the year-to-date returns for these groups. If you compare that to the year return for the leading groups, you will see why we advocate trading the top industry groups for sure. Now, let's move to sentiment. And this is the other one, alongside my moving averages indicator and the 52-week highs and lows indicator that I use, that is suggesting that we might be a bit too oversold and some bounce might be due. So here is the bulls minus the bears. This is the advisors, and you can see minus 42. 2020 COVID crash right here, minus 28. 2013 April, minus 35. We have not seen such bearishness in terms of the advisors. And if you look at it, 1 year bearish high, 59.4% last week. So basically the week that I'm talking about. We have not seen such bearishness for quite some time, and this is definitely the all-time, well, not the all-time, but the year high. So a lot of bearishness, which suggests that we might be seeing some pullback soon. Now, I'm not saying we will. As I said, advanced decline lines are suggesting we're going down. Some of the indicators are suggesting we might be bottoming. I tend to favor the idea that this might be bottoming out because of the volume that I'm seeing coming from below. And this is what you want to see when there is a reversal. You want to see the support of volume. But you never know. We'll see. In terms of the fear and greed index, this is, as you know, CNN's preparatory index, but I like to show it here in the video. I think it's really good to look at it. We are in fear. Previous week close was pretty much the same place. 1 week ago again, fear. So it's very fearful situation. We're not at the lows right here that we recorded in October. And I think this is March. But we're still getting to the 25 zone, which is extreme fear and oversold. In terms of Bitcoin, this is the fear and greed index for Bitcoin. We're in extreme fear right now. Price is hovering around 38,000. And in summary, I want to say this. You saw the risk vest model is on negative. The setups selective to none. I've traded some, but I had, I think, 3 positions to the downside and 2 to the upside. And the ones that I have for the upside are Arch, which is Investors Business Daily Markets Mid Growth 250 number 1, and CF, which is I think number 4 or 5. So I'm just gunning for the strongest of the names. If they're gonna make a push, they are all commodity related names, and I'm short pretty much everything else. The market is definitely in a markdown. The put volume is slightly elevated. We're 0.895 as I said. We need to move above 1 to actually feel like we're hitting a bottom. So there's still some space to go for puts. Volatility is elevated, as we saw the VIX. It's at 33.40 now, which is getting very extended. And you saw the rates, the inflation, war, earnings. So I would definitely suggest you are, if not owing cash, at least like 90% cash, and have smaller positions and be ready to exit fast, because we don't know what's going to happen tomorrow. So if you like what you see, please subscribe to our channel, visit our Discord as well. We have a lot of interesting things to show you there, as well as alerts from foreign analysts and things that you'll be really happy to find in terms of our trading community. So without further ado, I wish you a happy weekend, and I'll see you guys in our Discord server tomorrow. Bye bye.